So hi everyone. In this today's video, we will be understanding how to build a financial model. Now, normally for all finance professional, it is very much required to have an expertise on building the financial model. So first we try to understand what is this particular financial modeling means. So financial modeling is nothing but a structured financial representation, and we'll be using this particular financial modeling for valuation, nothing but business valuation, and for forecasting. So forecasting sales or forecasting revenue or forecasting cash flows. And it also aids the management in decision making. Nothing but it helps the management in decision making. So this is the main objective of building a financial model. Now, if you see the structure of financial model. So what exactly financial model consists of? So what are the major components which we need to include in the financial model? So every financial model, generally we prepare an assumption sheet, and we also include financial statements like income statement, balance sheet, and cash flow statement. And we'll also include one sheet of the calculation, the major calculations, and we'll also be including the valuation. And now how we will value by using the DCF, and we'll also include a dashboard. So if you see the financial model structure or nothing but the components, these are the major components, 5 components. Always make sure that if you are building a financial model, you need to compulsory include these particular 5 components. Assumptions, what are the assumptions you are considering to build a financial model? The three statements, financial statements, income statement, balance sheet, and cash flow, the major calculation sheet, the valuation sheet, and the dashboard. Next, here in order to have a better understanding, I took an example of Ultratech Cement. Now, if you see, because in the financial model, always we need to include a sheet connecting with the company overview. Now, if you see this particular Ultratech Cement overview, this is the India's largest cement company, and this is part of Aditya Birla Group, and this company is having strong market presence. Now, if you see the financial dashboard, so normally financial dashboard, if you see, as I mentioned, it generally includes the revenue trends, profit margin, cash flow, valuation summary. So it means it mainly focus on the revenue trends. It means what is the revenue, whether the revenue increased or decreased, what is Y on Y increase in the revenue, what is Y on Y increase in the profits, what that by what percentage revenue has been either increased or decreased compared to the last year, and similarly cash flows also by what percentage cash flow has been increased from last year to current year, and the valuation summary also. So generally we try to put it in the financial dashboard. Then when it comes to the assumptions, as I discussed at the beginning, the key assumptions. So normally what are the major key assumptions which we need to consider? The revenue growth. So we need to do sensitivity analysis. We should also do scenario analysis, and accordingly we need to know the revenue growth percentage. By what percentage the revenue is going to increase. So revenue growth is one of the key assumption. So at by what percentage? Maybe whether you are expecting the revenue to be increased by 5% or 6% or 10%. So how we will be knowing this particular percentage? How we can get this particular percentage? By doing the sensitive analysis, scenario analysis, by understanding the business environment. So there are several factors which are to be considered in order to get a specific percentage of revenue growth. Similarly, the cost estimate. It means by what percentage the cost is going to increase Y on Y. The tax rate, capex. So by what percentage, what is the company policy to increase the capex percentage every year? So these are the common things which we put it under the assumption sheet. Next, when it comes to the revenue calculation, so depending upon the business model, suppose for a software company, the major business is the client, the revenue from the client. Similarly, in this particular case, as we took example of Ultratech Cement, so on what basis the revenue is calculated? So normally the revenue is computed by volume into price. But at what price the product is sold, and what is the number of products the company planning to sell? Then nothing but volume into price. Demand driven, what is the demand for that particular product, Suppose if the company is dealing with the multiple products, so what is the demand for their each of their products, and regional pricing. So if the company is having the global pricing, nothing but the global presence, so the price might vary, the product price vary, the project price might vary. So it means these are the certain key components which we do consider for the revenue calculations. Then when it comes to the cost components, so for this particular business, as we took the example of Ultratech, what are the cost common? Because in order to prepare an effective financial model, you need to have a clear understanding about the cost components. What are the major cost contributors? Nothing but the cost components. So for this particular company, the cost components are raw material, power and fuel, logistics, and employee cost. So this should also be part of your financial model. Unless and until you have a clear understanding about the cost component, it is very difficult for the company to value. Then the income statement. So the common element, so the common things which we include, or the common extracts of the income statement is revenue, EBITDA, that is nothing but earning before interest, tax, depreciation and amortization, earning before interest and tax, and net profit. So for this particular company, if you see the net profit has been around $3 million, earning before interest and tax. Always do remember you need to have a clear knowledge about this. The best source to get this particular information, always viewers try to depend on the company annual report. So your primary source document should be the company annual report. Then for your secondary source, you can depend upon the other alternative sources, but always your primary focus or the primary source should be the company annual report. Then the balance sheet. Now the next statement is balance sheet, where we try to understand the assets, liabilities, equity. In assets also, what is the current assets, current liabilities, and the long-term assets and non-current liabilities. So this is also part of your financial model. Then the cash flow statement. So the major statement in the financial model is cash flow. It means how effectively the company business model is generating the cash. So what is the total cash inflow? What is the total cash outflow? So normally these particular cash flow is generally divided into three heads: cash from operating activities, investing activities, and financing activities. So operating activities, nothing but how much cash the company generated from their business model. What is the total cash inflow from the business model? Now, in the given case, as we took the example of Ultratech, so it means if the Ultratech cement is having almost 10 products, so how much cash the company generated by selling these particular 10 products? And how much cash outflow, or nothing but what is the total expenses incurred, nothing but the cash outflow for generating this particular cash inflow, like the total cash outflow towards the salaries, raw material purchases, direct expenses, and other expenses. So that is nothing but operating activities. Similarly, when it comes to the investing activities, so how much cash the company invested during the year, and it means if the company purchased an asset, then it is considered as cash outflow from investing activities. Similarly, how much cash the company received, what is the total cash inflow by disposing the assets, or nothing but if the company is having any property, plant and sorry, any investment properties, nothing but if the company is having any FDs, so how much interest the company received through FDs, or how much dividend a company received by investment in other companies. All this comes under investing activities. And when it comes to the financing activities, what is the total cash inflow which they raised by issuing the shares? What is the total cash inflow by borrowings? Nothing but when a company borrows, if the company prefers to go for an external borrowings, what is the total cash inflow? Or if the company repays any loan, or if the company pays any dividend to the shareholders, all this comes under financing activities. So it is mandatory, always it is advisable for you to include a detailed cash flow in your financial model, where the reader can understand the total cash inflows and outflows as per operating, investing, and financing. Then Next one is working capital. This is also a very important thing which we need to put it in your financial model. So working capital, or we also say it as operating cycle. So how many inventory days? How many inventory days is nothing but how many days the inventory is lying in the godown. Always the company need to have the lower inventory days. Receivable days. Company always need to have the lesser receivable days. Payable days. It is always preferred for a company to have a higher payable days. So this is nothing but working capital. We also say it as operating cycle or working capital cycle. So always it is recommended to put the inventory days of the company, receivable days of the company, and payable days. So why we need to include all these things? We can compare it with the market. We can compare it with the industries. Next, capex and depreciation. So normally, what is the total capital investments? Nothing but what is the investments on plant investments, assets growth, and what is the depreciation? Nothing but how much depreciation every year the company is claiming, at what percentage the company assets are growing, and what is the total investment in capital expenditure compared to the last year? What is the capital expenditure percentage comparison between your company and the industry? So all this also you need to include in your financial model. Financial forecasting, because the main objective of the financial model is to forecast for next 5 years. So by considering the past data, by considering the past revenue, by considering the past profit, by considering the past cost, we need to forecast. So how we will be forecasting? By considering the assumptions. Normally the revenue growth rate, the cost growth rates, everything. So we need to forecast the revenue. So the best thing to do in order to have an accurate forecasting is you need to do a proper sensitivity analysis and scenario analysis. So you need to project the revenue for the next 5 years, and you need to project the margin assumptions and future estimates also. Then competitor comparison. So we need to understand where your company stands in the market. So nothing but we consider it as competitor analysis. Always you need to put a competitor comparison in your financial model also. Who are the major competitors? What is their market share? What kind of products those companies are offering which is not offered by your company? What is your company share in the industry? So all these things we will be putting in a competitive comparison. For your understanding, the major competitors for this Ultratech cement, I took it as ACC, Ambuja Cement, and Sri Cement. So accordingly, the whatever company, the financial model which are constructing, accordingly we need to select their major competitors. So always better to take 3 to 4 competitors. Then the beta stands for risk. So normally, in order to understand the market volatility and the stock sensitivity, we'll be using this particular beta factor also. And as most of you might be knowing, we use this beta in order to compute the expected rate of return by using the CAPM model. CAPM is nothing but capital asset pricing model. So we use this particular beta. So in order to understand the sensitivity of your stock with the market, we always use this beta. So this beta computation should also be part of your financial model. Then only cost of capital, nothing but WACC, weighted average cost of capital. So in order to understand the capital structure and in order to know the cost of equity, cost of debt, we will be computing this weighted average cost of capital, and this is also part of your financial model. Then DCF valuation, because in order to predict the future cash flows, or in order to predict the terminal value and all these things, we will be going with the discounted cash flow valuation, where we will be discounting the future cash flows by using a specific discount factor. And this is helpful to compute the intrinsic value of a company. In the given diagram also, viewers, you can observe the present value and cash flow after 1 year, cash flow after 2 years, and cash flow after 3 years. Generally, the most commonly used business valuation technique is discounted cash flow valuation. By using a specific discount factor as per the credibility of the company, we try to compute the present value of the prospective cash flows of your business. Then the terminal value. So terminal value should also be part of your financial model. The main objective of this particular terminal value is to know the long-term growth and the final valuation component. So in order to go for a final valuation, we will be using these particular terminal values. So present value and the terminal value. So terminal value is generally computed by using the forecasted cash flows where we used DCF for it. Then the target price. So generally what should be the target? What is the current market price of your company share and what is the target price? That is nothing but the equity value, the share outstanding. Then the financial model report. So normally by using all these data, DCF, assumptions, competitor analysis, beta factor, by using all these particular information, we try to prepare a final financial model report. So it is nothing but the collection of insights, the dashboards, valuation summary, and finally we try to give a recommendation to the investor whether to buy that particular stock, whether to sell that particular stock, whether to hold that particular stock. This is nothing but a final report given to the investor, nothing but to your client. You can see a sample financial model report also on the slide.